Welcome back to the third installment of the Small Business Loan Application Workshop. We will examine the key deciding elements Climb Fund reviews when considering a loan request. Getting a small business loan can feel daunting, but it's definitely achievable. When underwriting a small business loan, we use the 5 C's of credit: character, capacity, collateral, capital, and condition. Lenders look at each one when assessing if the business is lender ready. We'll talk about what these terms mean to an underwriter. The first thing is character. It's an indicator of whether the business owner will repay the debt. First of all, is the business owner qualified to run this business? When a lender evaluates a small business loan application, they often look at the business acumen of the borrower to assess the likelihood of the business's success and its ability to repay the loan. We see a lot of people want to open a restaurant because they've perfected their grandmother's recipes, but they have no idea how to price, how to manage inventory, and so on. It's one of the reasons we ask for a resume in the application package. The resume will tell us the education and work experience of the business owner. Another part of character is the business owner's personal credit history. The theory is that if you have a history of paying lenders back as agreed, you probably will pay a new loan, too. Don't let your credit history be a negative surprise to the underwriter. One place to go is annualcreditreport.com. Backed by the Consumer Financial Protection Bureau, you have yearly access to your free credit report. If you do have a period of time when you had slow or no payments, it may not stop you from getting a loan. We understand that things can happen that make it temporarily impossible to pay your bills on a timely basis. What we want to see is that you are currently in a better financial place, and you are ready to take on new debt. Just write a small paragraph about what happened to you that you couldn't pay your bills on time and where you are now. Next up, how much money do you make, and how much of it must service past debt? We average the business owner's current income and the income from the last 2 years. The theory here is that if the business doesn't work out the way we believe it will, the business owner can return to their former line of work. Along with income is prudent spending, keeping personal debt repayment less than 40% of income, meaning that for every dollar you make, no more than 40 cents goes to pay debt and living expenses. And lastly, the personal financial statement shows a ratio of what a business owner has and what they owe. If you've never applied for a business loan before, you may not be familiar with a personal financial statement. Here's an example of one. You can see over on the left side we have a list of everything this person has, called assets, and on the right side we have a list of everything this person owes, called liabilities. Assets are things like your savings, your home or other real estate, stocks and bonds, and automobiles. Liabilities are debts that you have, like balances on credit cards, revolving lines of credit, mortgages on real estate, or unpaid taxes. The details about your assets and liabilities are listed on a separate schedule. So on this example, the total assets here are $469,000 and the liabilities are $280,000, creating a net worth of $189,000. On the other hand, this personal financial statement shows that this person has a negative net worth of $11,500. If you have a negative net worth, there are many legitimate reasons for why that might be the case. You could have just purchased a home. You could have student loans outstanding. There are lots of good reasons for someone to have a negative net worth. This will not have a direct bearing on a loan decision, but it gives the underwriter a clear understanding of your stability. The personal financial statement also serves as a character test. People tend to be very detailed about their assets, but get a little foggy about how much they still owe in their liabilities. If the personal financial statement is filled out incompletely or dishonestly, it will make us question your character and how you will keep the business's financials. As we mentioned, there are certain areas we want to see the information broken out with more detail. Here's an example of the schedules for a personal financial statement. Schedule A is where you list any real estate, including the address, the type of real estate, who owns it, the purchase price and date, present market value, the amount of the mortgage, the lender, and the repayment terms. Schedule C is where you would list any revolving lines of credit or credit cards. You can see what bank the credit cards are with, along with the monthly payment and the current balance outstanding. So, it just gives us some more detail. Moving on to the second, C, capacity. The question is basically, does this business have enough cash to make the loan payments? Capacity in underwriting is cash flow. Will the business have enough cash to pay bills when they are due? If it's doubtful or only based on projections, then we'll look to the business owner's personal cash flow. If the business and the personal cash are the same, we'll look for a source of income outside of the business, such as a spouse, family member, or an outside guarantor. A lender looks for discretionary cash flow, meaning excess cash after debt repayment. Or can the business owners personally repay the loan if the business fails? If you're already in business, the underwriter can look at your current and historical financial statements to determine cash flow. But if your business is a startup or the purpose of your loan request will significantly change your cash flow, you'll need to create a pro forma projections worksheet as a part of your application package. In Latin, pro forma means, as a matter of form, or, for the sake of form. At its core, pro forma projections are a researched exercise in which you project what the revenue and expenses of the business will be. We need this monthly for the first year to understand seasonality, and then annually for years 2 and 3 to understand trends. As a research exercise, the numbers that you use in your projections are only going to be as good as the research that you put into them. We had a client that wanted to open a quick casual restaurant downtown. She stood in front of her likely competitors at lunch a few times on different days of the week, using a clicker to get a head count. She knew the average lunch price, and researched how much the restaurants probably paid for the ingredients. Since her restaurant would be a new concept, she based her projections around 20% lower than the average number of customers, and she was very close to being exactly right. She actually did a little better than projected. Another idea is to call a similar business in a different market and offer to send them lunch if they would give you a half hour to ask them questions about their business. Almost all underwriters tend to look at the pro forma before they read your business plan. The underwriter will use the projections to make sure you're asking for the appropriate amount of funds. They may look at the projections and suggest you take a larger loan to ensure you have enough working capital funds. There is a lot of assistance to help you create a pro forma, such as your local Small Business Development Center, SCORE Chapter, Women's Business Center, or Veterans Business Center. These organizations have professionals on staff that can assist you with this at no cost to. Climb Fund has a video on our website called Projections 101, where you can see step-by-step creation of a set of projections. Let's take a look at a sample pro forma. You'll start at sales projections. Regardless of your industry you're in, there will be some seasonality in sales. Using this example, Product 1 sells much better in the summer month, so much so we can raise the price. On the other hand, Product 2 sells much better in the cooler months. In January, you can see that Product 1 sold 100 units at $10 a unit, creating $1,000 in revenue. That same month 500 units of Product 2 sold at $15 a piece, creating $7,500 in revenue for Product 2. The total gross revenue in January was $8,500. January's gross revenue was $8,500, but we had to purchase the products, otherwise known as cost of goods sold. Here both products cost $2 wholesale. The 100 units of Product 1 we sold in January cost us $200, and the 500 units of Product 2 costs $1,000. We established that the total gross revenue in January was $8,500. Cost of goods sold is exactly what it sounds like. It's the cost of acquiring the products you sell. The cost of goods totaled $1,200. Subtract from your revenue figures, this leaves you with $7,300 of a gross profit. Now that we know our gross profit, we must take out all of the expenses to get to a net profit. Things like rent, utilities, insurance, payroll, marketing and more, the expenses don't have a lot of seasonality. Once you have done the research to estimate what your monthly expenses will be, you should have a pretty good idea of where your break-even point is. And once you know where your break-even point is, then you know how much revenue you need to cover your monthly expenses. Remember when we said that our two products had severe seasonality to them? April isn't really warm or cool, so both of our products were in low demand. We didn't sell enough product to cover all of the expenses. That's why cash forecasting or creating cash flow projections is so important. You have cash at the beginning of the month, then you have revenue generating activities, in this example sales, so you bring in cash. But you have to pay for inventory or cost of goods sold, and then you have normal expenses. In this example we started January with $24,700 cash on hand. We had $8,000 in sales, and we made $6,130 in expenses, so we ended the month up with $26,570. Your cash flow projections is the most important part of your business plan. It will show you how much to keep in cash reserves to get through less profitable months. The next in our 5 C's of credit is collateral. Collateral is an asset or property that a borrower offers to a lender as security for a loan. Some common examples are real estate, vehicles, stocks, or savings accounts. Collateral comes into play if the business is unable to repay the loan. The lender can liquidate the collateral to pay off the debt. Of course, the collateral is never in danger if the loan is repaid as agreed. Collateral is hard assets which mitigate the risk of lending. Generally speaking, collateral should be easily liquidated if the business and business owners don't repay the loan. Some things that we can't accept as collateral would be inventory, your accounts receivable, or items that cannot be held in safekeeping. Interest in timeshare properties, boats, and other recreational vehicles are also not accepted. Something that we always accept as collateral is the business fixture, furniture, and equipment. We place a Universal Commercial Code, or UCC, with the Secretary of State. All business owners with an ownership stake of 20% or more are required to personally guarantee that the loan is repaid. In your application, there is a spot for you to list your collateral, and it looks very similar to this. As you can see, we list the description of the asset, how much it's worth, and if it has a lien on it, who owns that lien. We understand that you can't pledge what you don't have. In cases where there isn't enough collateral to fully secure the loan, a guarantee from a separate business or personal guarantee from an outside source that has liquidity or disposable income can alleviate the risk for the lender. However, you should be prepared to take as much risk as you are asking the lender to take. If you have equity in real estate, but you are unwilling to put up your house to secure the loan, we take that as a sign that you are not confident that the loan will be fully repaid. If the loan is paid as agreed, the collateral is never at risk. The next of our 5 C's of credit is capital. Capital refers to the money or assets that a borrower personally invests in a business or project. It shows the lender that the borrower has some skin in the game, or a personal financial stake, which reduces the lender's risk. You may have heard that 4 out of 5 new small businesses fail in the first 5 years. Well, that's not entirely true. Most people start a new business because they don't want a boss. But then making the hard decisions lies on the business owner's shoulders. Who to hire, who to fire, supplier negotiations, it's tough work. So out of the 4 businesses that didn't stay open, about half the business owners decided to close the business and walked away. But the more funds the business owner has personally invested in the business, the harder it is to shut the business down just because it's harder than first thought. And after 5 years or so, businesses typically start running a little smoother and employees are more seasoned, and the business owner is more comfortable in their abilities to operate, so the business stays open. To find out how much the business owner has invested in the business, we need to know what the total cost of the project is going to be. This part is all about the numbers. In your application package, please provide copies of quotes, estimates, and contracts. Include the things you found while you research for your business plan and projections. The underwriter needs to understand the uses of loan proceeds and proof of how much is each item going to cost. So, please break that down and be as detailed as you possibly can. We get a lot of applications for $50,000 or $100,000, but when we get a loan request for $73,643.78, we know someone has done their research. When we look at the uses of capital, we also want to know if the company have assets. And perhaps more importantly, were the business expenditures reasonable? For example, if we see a landscaping business request funding for a $10,000 printer, will the business have to investigate the business owner's decisions? If you are an existing business, underwriting will examine your balance sheet to determine if your business has the capital and has leveraged any debt to acquire more assets. And we want to see if the business owner has skin in the game, or their own funds in the business. Climb Fund doesn't have a hard rule how much you invest in the project. But there is no such thing as 100% financing in business. The more you invest in the project makes the credit request less risky. But the good news is that unlike traditional lenders, Climb Fund looks backwards. Traditional lenders want to see cash in the bank, ready to deploy into the business. Climb Fund looks at what you've already invested into the project. We had an applicant that wanted to open a woman's clothing store. She didn't have a lot of cash available, but she had planned the business for years, starting with her babysitting money. She collected items like mirrors, display racks, rugs, dressers, and more. When she listed all of the purchases, she had spent over $25,000. When she gifted those items to the shop, we counted those expenditures as the owner's investment. And we found additional items for collateral. Climb Fund recognizes other debt that the business owner personally guaranteed as the owner's investment. Over the last 10 or 15 years, we've seen an explosion of online small business lenders. Names like On Deck, Cabbage, Lending Club, Prosper, and Square Capital, along with other merchant machine lenders. The upside with online lenders is that you can usually get a loan from them quickly and without too much effort. However, these lenders are not regulated like traditional banks. They don't have to disclose their APR, or annual percentage rate, which shows all of the fees associated with the debt. We have had applicants that thought their loan had a 14% interest rate, not bad compared to a credit card. But when we saw the payment and put it into our amortization schedule, that 14% rate was more like 40%. If it's too good to be true, it probably isn't. More and more CDFIs won't refinance this kind of debt. But a good option could be crowdfunding. If you've got a story to tell, there could be people willing to donate into your project. Here's a list of a few crowdfunding sites, but new ones pop up all the time. It goes something like this: you're opening a bakery. If someone donates $20, they get a coupon for half-priced cookies when you open. $50 donation gets a free cake. $100 donation gets the cake and a dozen cupcakes. You get the idea. We've had applicants use these platforms to not only reduce the amount of their loan, but to also get the buzz out about their business opening. These sites do have costs associated with them, and some won't let you have any funds if you don't raise the entire amount. Here's another research assignment, and there's a whole PR industry that specialize in these sites, but at a cost. But if your story is special or exciting, usually the benefits outweigh the costs. The last of the 5 C's of credit is conditions. What are the conditions surrounding the business, and what are the conditions of the market? These things are out of your control, but they are a risk factor for the lender. The lender will look at the market conditions that the business will operate in. If you have done a SWOT analysis, it's very possible that you may have already covered much of this. You should be able to demonstrate that you are knowledgeable on these conditions and know how to address them. This completes the Small Business Lending Decision-Making Factors portion of our presentation. In our next video, we'll summarize the process, discuss who you'll be working with as you move through our pipeline, and share a few of our most successful clients. In addition, you'll get the key phrase needed to get a Climb Fund application.